countries. And Kasey will talk to us about the issues involved and also some suggestions how this could be introduced in the next regime. Kasey?
Thank you, Professor. Good morning. Thank you for this opportunity to address you this morning to talk about insurance. I'm going to briefly touch on the most important roles insurance either plays or can play for low-lying countries, and what proposals are out there to be incorporated into the UNFCCC's post-2012 agreement. I should mention that this is in no way a comprehensive list, but just a summary of the most prominent ways to reduce risk in regards to using insurance for climate change. Article 4.8 of the UNFCCC mentions insurance to be used to help developing countries adapt to climate change. At COP14 in December, some proposals on adaptation were made more concrete. And in March of this year, the UNFCCC released the so-called components paper, which is a forerunner for the negotiation text for COP15, and insurance was recommended. It's important to point out the basics of insurance, and one key element is that insurance companies do not reduce risk, they spread it, which is known as the risk transfer principle or risk pooling. Therefore, a key element of climate insurance is to have a large insurance pool by educating and incentivizing citizens and businesses in your countries to join schemes, and if possible, to have your country join a regional or multi-governmental scheme to spread risk and reduce costs. The second principle that is really important for adaptation is that of moral hazards. This hazard occurs when those that are insured, or in some developing countries, know they will be compensated by their governments in the event of a disaster, are more likely to increase risky behaviors. This can be avoided in future schemes by making certain risk reduction measures mandatory to participate in a program. There's no need to reinvent the wheel when we're devising these new schemes. The disaster risk reduction community and tourism industries have been working with the insurance sector for some time, and so those experiences should be drawn on when devising new schemes. For instance, because it's not practical to insure risks that are certain in high-risk areas such as tourist resorts and cyclone zones, we are finding it increasingly more difficult to be able to afford high premiums. In some instances, insurance companies have either withdrawn cover or provided incentives, such as reduced premiums, if risk-reducing measures are implemented, such as in Fiji. And that's a great model that we need to use for the other sectors that are going to be impacted by climate change. As you can see from this International Disaster Database graph, natural disasters have been severely on the rise. Climate change will exacerbate these events, and so a lot of early efforts to address climate change have been focused on disasters and catastrophes. But we also need to consider slow onset disasters, which has been mentioned because of sea level rise with the newer projections from Ramstor especially, but also drought impacts to agriculture and fisheries. Some insurance schemes are already up and running for catastrophic events, but slow onset insurance schemes are just starting to catch up. Climate insurance tools for adaptation can be divided into two forms: stochastic, or sudden either catastrophes or disaster insurance, but also slow onset or progressive insurance. And these are different tools that have either been currently used or are in the process of being proposed for future plans. There are ways to manage and minimize losses to reduce risk and reduce costs to developing countries that can be incorporated into insurance schemes or used independently, especially for uninsurable communities. 75% of the economic costs of great climatic disasters are uninsured. Currently, in high-income countries, about a third of natural disaster losses are insured. But in developing countries, less than 3% of households and businesses have catastrophe insurance. This map shows the world's microinsurance availability and type by country to give an example of how insurance has not penetrated all regions. And unfortunately, the world's most disaster-prone areas do not have insurance cultures. This highlights the need for increased penetration within your countries. It's important to note that some climate insurance programs would not cover uninsurable risks or communities without access to insurance. In some cases, the private sector might not be willing to accept risk in the classical insurance mode, but it still could provide a rich array of other services and skills to support a publicly funded insurance system. Public-private partnerships are key for these kinds of communities. a number of proposals before the UNFCCC, proposals from development organizations within countries, and some initiatives that are already operational. The two most popular proposals for the post-2012 agreement are from AOSIS and the Munich Climate Insurance Initiative, MCII, which I will discuss really briefly. As you all may know, in 1992, AOSIS proposed an international insurance set of sea level rise, and since then has been expanded to include a new window mechanism. It's been suggested that payments into this pool would be a form of compensation linked to responsibility or liability for the impacts of climate change, the polluter pays principle. The proposal was a necessary first step, especially mentioning because of the fact that there are slow onset insurances just starting to come about. But there are difficult challenges in implementing the proposal. For instance, there may be difficulties in the application of the polluter pays principle. Also, valuing all properties and verifying loss claims in countries with no indigenous insurance structures would impose large transaction costs to the system. By coupling this proposal with the MCII, some of these challenges can be mitigated, since the MCII proposal does not cover progressive slow onset impacts. The MCII initiative was designed to complement the AOSIS proposal. And going back to some of the basics that we discussed earlier of risk reduction and insurance, countries are eligible only if they show progress on a risk management strategy. That reduces that moral hazard principle that we talked about earlier. Tier 1 would be for premium paying countries have an added incentive to provide aid for prevention, and the Tier 2 reduces moral hazards, and the scheme fosters development and thus resilience to disasters and other environmental changes. Also, Tier 2 is designed to include those who face uninsurable risks, which many communities are. Also, we have CRIF, the Caribbean Catastrophe Risk Insurance Facility, which is up and operational. It's an example of how new forms of public-private partnerships can make societies more resilient by securing finances before an event occurs through multi-nation involvement. Thus, it transfers the risk through a larger insurance pool. Traditionally, insurance payouts are made after an event occurred and can take months or even years to figure out damage estimates. CRIF is a model-based approach, using a recent innovation of basing disaster payouts on objective hazard intensity measurements, such as wind speed or earthquake intensity. The risk transfer principle comes into play here. By pooling their risk, the 16 Caribbean countries save approximately 40% on what each government would have paid had they negotiated individually through commercial insurance markets. And here are our take-home messages, kind of bringing this all together. For utilizing insurance in your countries to adapt to climate change and to incorporate an insurance scheme into the post-2012 international climate regime. AOSIS has it right with their scheme to address slow onset insurance. We need to bring more attention to gradual progressive changes and how to reduce risks and make insurance affordable. To avoid the moral hazard problem of the insurance taking more risks instead of less, taking more risks instead of less, would make communities more vulnerable. Therefore, risk management should be a prerequisite for offering support. And also utilizing that risk transfer principle of having public-private partnerships and multi-government schemes, incorporating all those different elements of those two principles. And of course, we need to consider the uninsurable. Therefore, we need to look to non-traditional approaches using insurance.
Thank you, Kasey. From insurance, we now turn to forestry.